Sorry about that. Well, on Business Incorporated today. Two oil giants declare force majeure in Nigeria. Investors see African bonds as a hedge. Virtual boardroom meetings for Africa Investment Forum begins today. Hello and welcome to the program. This is Business Incorporated. I'm Ini John Mekwa. We'll begin the show as usual with intraday market here in Africa, where most of the markets were negative as intraday Nigeria's main index was down marginally though, following yesterday's sentiment. South Africa's JSC dipped also 2.64. In Egypt, the EJX30 fell 0.58 and Kenya closed yesterday's trading positive. Well, we move to the Middle East. Still negative sentiment spill across the major markets there at intraday. In the UAE, Dubai's index dropped by 1.44%, while Abu Dhabi index lost 0.65%. Elsewhere in the region, Saudi Arabia's index fell 0.62%. Qatari index recorded the biggest drop of 1.74% at intraday. We move to the EU now. The EU has agreed on a fourth package of sanctions against Russia, targeting metals and adding Roman Abramovich, the owner, or rather the former owner now, of Chelsea Football Club, to the EU blacklist. DW's Stephen Birdsley joins us from Berlin now with more. Well, Stephen, it'll be interesting to know what sticks out in this round of sanctions.
Well, there's a number of items covered under these sanctions, but one of the things that does stick out is a ban, an import ban on iron and steel. We don't have the exact names of the products. There are various iron and steel products that could be covered under this. But we expect that it would be disruptive to global markets. Now, prices have already risen for iron and steel in recent days, given fears that there could be a shortage. Also, we know that some purchases have been cut short over fear out of contravening sanctions. So that is one reason why prices are rising as well. There's also input costs are rising across Europe and the UK, for example, for producing steel. And I'm talking about energy, the cost of energy rising substantially, a significant amount of energy needed to produce steel from iron ore. So it's already rising high. We're going to see what happens in the coming days. This, of course, is important for many other industries, such as the auto industry. As for Roman Abramovich, this new sanction would extend what's already been done in the UK. You know, a lot of limits put on what he can do with Chelsea. He's supposedly planning on a sale of the football club. But of course, the way sanctions are designed, he would not actually receive any of the proceeds of it. So this would just extend those sanctions further out to the EU room.
Yeah, and you mentioned the steel and market for the metal, nickel. It's been especially wild since last week. Has it calmed down now?
That's right. Nickel has really stole the headlines in the past few days. There was a trading suspension actually last week after prices soared to $100,000 a ton. That was a doubling of the price from the day before. And within a week, the price had quadrupled. That is, nickel was around $25,000 a ton at the beginning of the invasion. So you can see just how much the speculation and fears that it would be, end up being short on the global economy due to closing down from Russia. That's really driven the prices up. We don't know if there's going to be a bit more moderation when trading does begin on Wednesday. We don't know how buyers are going to approach it. It's not covered by any sanctions right now, but it is a very important component for the auto industry, especially when you look at battery production. A huge emphasis right now on lithium-ion batteries, and nickel is important for that. Russia is the world's #3 exporter of nickel ore, so that's where those fears are coming from.
And then the market is also another reaction to all of this. How's the market looking at this time?
That's right. Oil taking a tumble, actually, that surprised many. But one of the reasons behind that, two reasons really. One is that there was some optimism in the talks between Russia and Ukraine, and traders are looking for any signs of optimism right now. But another is that there are increasing signs that the Chinese economy may be weakening. And so both of those together help drive those prices down. We're going to have to see what happens today, but Asian markets are still being hit by those fears over the Chinese economy, especially when you look at the virus-related news. The city of Shenzhen pretty much locked down. That's one of the biggest production cities, one of the biggest production hubs in all of China. When it comes to the DAX actually saw a pretty good day yesterday. We'll have to see what happens Tuesday. Expectations are that it could actually dip a little bit.
Oh, thank you so much, Stephen. Enjoy the rest of your day. Well, in the United Kingdom, more wealthy Russians and businesses are being sanctioned with a view, of course, of putting pressure on President Vladimir Putin to stop the war in Ukraine. Juliana joins us now from London to give us updates on some of these sanctions. Hello, Juliana. Good afternoon.
Good afternoon, Innie.
Yeah, so the UK has hit Russian imports now with new tariffs. Tell us more about this.
Well, yeah, we've entered into the third week of Putin's war in Ukraine, and the West have been very strong on their point, which is to stop the Russian regime benefiting from the international rule-based system if they don't abide by it. So there are two measures that have been set out today. One is a coordinated effort by G7 allies, which has been led by Britain, and this is to stop immediate, effectively, any exporting of luxury goods into Russia. And now, if you are close to the Kremlin, close to Putin's regime, you are probably going to like luxury items such as Gucci and Fendi, Hermes, luxury yachts, really beautiful pieces of art. They are no longer going to be able to go into Russia. We already know some really big luxury companies like Land Rover, Range Rover, Land Rover Jaguar, and others have stopped producing any items in Russia, and this is going to add to that. Then, of course, as well, Britain has a pretty robust trade relationship with Russia. This is going to come to an end in part because the British government has slapped a very high tariff of 35% on all goods that are going to be imported from Russia into the UK. So this is going to affect commodities such as fertilizer, Russian vodka, which is another produce that has been in the headlines over the past couple of days. Now, this is likely going to have retaliatory measures. Boris Johnson, in the piece that he wrote in the Telegraph this morning, did say it is going to economically cause some pain to Brits over the coming days, particularly if you look at last month. I believe a trade between Russia and the United Kingdom was worth about £135 million. Last year it was worth £3 billion. So, of course, if Britain has slapped this huge tariff of 35% higher fees on these Russian imports, then, of course, we can only expect the same going back.
Yeah, and do we call him the former owner of Chelsea FC or the owner of Chelsea FC is also getting new rounds of sanctions?
Yeah, it's a pretty much a grey area. Yeah, so this is going on from what you were just discussing in Germany. The EU have put together, I think they've just finished writing the draft of this fourth round of sanctions, again, to try and, tighten the grip around the Kremlin's neck, so to speak. So they have named several businesses and, of course, wealthy oligarchs. Roman Abramovich is on that list. Just last week, he was sanctioned by the British government after lots of pressure from the opposition parties. As you said, he was once a very, very popular, well-known owner of Chelsea FC, very popular here in London. And as the investigation is ongoing, some secret properties that are owned by him have all come out in the wash. One of them is a £15 million property that is located on Kensington Kensington is actually a 15-bedroom mansion, sorry, so I know it's not going to be worth £15 million, probably times that by 5, Innie. Kensington Palace Gardens, for those in the know, is known as Billionaires Row, so you can imagine the type of people that live on there. Now, it is owned by a company, not Roman Abramovich, so again, another grey area about whether or not he is, that can be seized and sanctioned. But the main headline is that that property is on a piece of land that's owned by the Crown Estates. This was a firm set up by the British government to look after a royal property. If you do own a home that sits on land owned by the Queen, then you have to pay a substantial amount of rent. And now we're hearing that that rent cannot be paid because, of course, Roman Abramovich cannot do business in the UK. Apparently, he's on his way to Turkey. There was some pretty gloomy pictures of him being sitting in an Israeli airport, and the search for his treasures continues.
Yeah, continues indeed. So how's the market reacting to all of this?
Well, at intraday, the FTSE all share is down 0.93%. The FTSE 100 is down by 0.94%, and the FTSE 250 is down by 1.21%. Triple-digit losses there. In the currencies market, the British pound is currently trading up against the US dollar by 0.36%, though it's down against the euro by 0.04% and up against the Japanese yen by 0.13% at intraday. Those are labour market data, although it was robust this morning. There are concerns about the rising squeeze on British consumers as they're paying more for their groceries and they're paying more when they get home, because we know we've got that hike to our energy bills coming in a matter of weeks.
Well, thank you so much. Not very good times, Juliana, but we'll keep pushing.
Yeah, thank you.
Let's go to Asia now, where shares in China lags among Asia-Pacific markets with the release of much better than expected Chinese economic data offering little respite. Hong Kong's Hang Seng Index fell more than 6% in the afternoon trade before seeing a slight recovery from those losses, falling 5.72% to 18,415.08. That's its lowest since February 2016. Chinese tech stocks in Hong Kong were volatile in trading through the day. Hang Seng Tech Index tumbled more than 7% and then briefly crossed into positive territory before erasing those gains. Let's go to the United States now, where stock futures edge into the green as oil prices continue to drop further below $100, boosting hopes that energy prices won't drag the U.S. economy into a recession. The gains were muted in volatile trading as traders continue to eye the latest with ceasefire negotiations in Ukraine and China COVID-19 lockdown that could wreak havoc on tech supply chains. Investors were also reluctant to commit capital ahead of a big Federal Reserve monetary decision, which is up for tomorrow, where the central bank is expected to hike rates for the first time since 2018. Dow Jones Industrial Average futures traded marginally higher. S&P 500 and Nasdaq 100 futures gained 0.1% and 0.3% respectively. Earlier in the session, futures were down slightly. A slew of energy names were under pressure in the pre-markets. And in the global oil space, now prices slid to a two-week low on continued ceasefire talks between Russia and Ukraine and concerns about demand in China after a surge in COVID-19 cases. Brent futures dropped at $6 to trade at $100.69 per barrel after falling 5.1% the previous day. U.S. West Texas Intermediate crude also slid 6.21% to trade at $96.81 a barrel. We'll just take a break. When we come back, we have stories from the African continent for you. Do stay with us. You're welcome back. You're still watching Business Incorporated here on Channels Television, where Shell Petroleum Development Company, the local unit of Royal Dutch Shell, has declared force majeure on Bonny Light oil export program beginning from the 3rd of March, citing a decline in flows to the export terminal. On the same day, Italian energy giant ENI has also declared the same measure on exports of Brass River crude oil, triggered by a pipeline explosion in Bayelsa State. Force majeure legally allows a company not to meet contractual obligations for reasons that are out of its control. The twin occurrences is likely to further pressure a market reeling from the weight implication of Russian occupation of Ukraine by complicating supply woes. The two Nigerian grades, Bonny Light and Brass River, were part of a shipment program of 170,000 barrels of crude oil per day for April, even though they have seen a continuous, for years now, a continuous decline. From the oil space, now let's see what's happening in a commodity space. Amid the Russia-Ukraine conflict, a global commodity super cycle has been seen. Many commodities have hit their highs. Maize is among that. The price of maize has spiked by 30% year to date and 104.5% over the past 2 years. And Ukraine is the 6th largest producer of exporter of maize in the world. In the going year, it's produced 42 million metric tons. Well, we have joining us now from Financial Derivatives to tell us what this would mean to Nigeria and, of course, some other African countries. Hello. So in what ways can import-dependent countries hedge against the supply shortfall that will be created by these conflicts?
Thank you very much for having me today. As regards how import-dependent countries can mitigate against this supply shortfall, it's a very dicey one because we know for a fact that products like maize, wheat, nickel that Ukraine produces and supplies the world's supply chain are also products that Russia also has an interest in. They also have a comparative advantage in those commodities as well. So in the sense that, to the extent that other countries might not be able to get their supply from Ukraine at the moment, we might also see Russia wanting to weaponize its own supply. And therefore, it's going to cause some sort of scarcity, and there's almost no way really to mitigate against this. Of course, we might end up seeing import-dependent countries pivot, transition, and see them go to other suppliers of these same products. And we're also going to see that there's going to be some price increases ultimately, and it's not going to be good for these import-dependent countries. But to the extent that there is currently this conflict between Russia and Ukraine, then it's going to be hard for import-dependent countries to actually mitigate against price increases or this supply shortfall. There's going to be some scarcity either way.
Yeah, obviously. Well, Shay, maize is an important raw material for feedstock, the production of ethanol. The global demand for industrial ethanol has grown steadily in the recent years. How do you think this surge in ethanol demand will impact dynamics of the maize market in Nigeria, especially at a time like this when Ukraine cannot contribute its quota to the global supply?
Yes, we should note. It basically goes back to the rules of economics, demand and supply. Increased demand for a particular product from which we also get ethanol will subsequently lead to an increase in prices. And subsequently, if there's a supply shortfall, then of course it's even going to cause even more increase in prices. So to the extent that Nigeria has a comparative advantage in this regard, the U.S. Department of Agriculture estimated that we produced about we're the 14th largest producer of maize in Africa in 2019, 2020. So of course, this sees us in a very good position. The problem, however, is that we haven't even met our local demand in terms of food, in terms of feed, animal feed for our poultry. So of course, as long as there's that demand shortfall, then it's going to be incredibly hard for Nigeria to even look at these other places. And also, in so doing, we might not necessarily be able to position ourselves to benefit from this sort of thing. But ultimately, if we have a capacity, we increase our capacity to meet our local demand, then we can begin to look at ethanol production and supplying maize for ethanol production to other people across the globe.
Yeah, and then just before we let you go, there seems to be a wide variation between the price of maize and food inflation. Is there a way to explain this?
Okay, yes, ultimately, I think we need to look at the composition of the CPI basket. Now, we know that food makes up about 51% of our CPI basket, and we need to look at how much of a contribution maize has to that CPI basket. If it's a very small proportion, then, I mean, whatever increase it is, if there's a small proportion of maize compared to other food products in the food basket, in the food component of the CPI basket, then of course it's going to be, I mean, whatever price increases you see in maize will be masked compared to the contribution of other food products. So basically, that's where we need to look at. And ultimately, that's why there's such a disparity, because if the composition of maize is small, then of course it's not going to be significant when it comes to looking at the headline inflation numbers or food inflation numbers.
Much for giving us that analysis. Sheyi Midura is an analyst with financial derivatives company of Nine. Thank you so much for your thoughts.
Thank you very much.
Moving on now, African bond is selling really fast at this time as African hard currency sovereign debts. All of it have been rated junk. It's finding buyers as investors look to shield their cash from the fallout of the war in Ukraine. Of the 9 developing countries which have seen their debts gain amid the risk of off-mood, 4 are countries in Africa which are isolated from the conflict, both geographically and because they export some of their commodities that have surged as a result of it. South Africa rated 3 steps below investment grade at S&P Global Ratings, is leading that pack, benefiting from the war at this time. For other African borrowers, outperformance has been driven by relocation as well as higher oil prices, which have helped the likes of Angola, Gabon, and Nigeria is supposed to be on that list. Also, the Africa Investment Forum has started its boardroom sessions, which will end on Thursday, the 17th of March. The meeting is virtual and will showcase more than $50 billion of curated bankable projects to investors. The featured projects are in key priority sectors identified in the Africa Investment Forum's 2020 Unified Response to COVID-19 initiative. The sectors include agriculture, agro-processing, education, energy and climate, healthcare, minerals and mining, information and communication technology, and telecommunication, among others. The Central Bank of Tunisia has left its benchmark interest rate unchanged, but says the country will need more financing for its budget as the war in Ukraine sends commodity and energy prices soaring. The Regulators Board called for extreme caution and adoption of proactive approach to offset the conflict impact. Without such measures, the North African crop and energy importer may see a worsening of the balance of current operations deficit and exacerbation of inflationary pressure over the forthcoming period. And a year after a giant container ship got stuck in the Suez Canal for almost a week and disrupted global trade for months, another Evergreen Marine Corp vessel has run aground. This time, it's near the U.S. Capitol. The Hong Kong-flagged Everforward got stranded after departing the port of Baltimore Seagirt Terminal on Sunday night. The 334-meter vessel was en route Norfolk, Virginia, when it got stuck. And while the ship's grounding is not preventing other ships from transiting to the port of Baltimore, efforts have been underway since last night to try and free the ship, and it is to continue today. That's the program for today. Thank you so much for being a part of it. Let's do it again tomorrow. I'm Ini John Mekwa.